Hello, and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the beautiful, very rainy Pacific Northwest. It is the first 30-Minute Thursday of 2022. Happy New Year to everybody, and welcome. It's so nice to see you guys. I hope you guys had a great holiday season. I hope everyone's staying healthy and sane, and staying safe as well, and that you're ready to hit the ground running for another great year. They're all great years. Any year above ground is a great year. So welcome to 2022 and to 30-Minute Thursday. I want to jump right into following up on something that I mentioned and that I was talking about in my last conversation with you guys, which is the forecast. We're in a brand new year, and boy, what a difference a day makes, as the song says. What a difference in the new year. There are some things going on here, and there are some real major implications to the mortgage industry, the stock market, the real estate industry, and as a result of that, to all of us, really, because we're all, in one way or another, invested in these institutions. If you have a 401k or an IRA or something of that nature, then by all means, the stock market is an important part of your overall financial health. If you own a home or you're thinking of buying a home, then the real estate market, and by extension, the mortgage market, all of it has a huge impact on our finances, on our well-being financially. And so I want to kind of jump in here and share a little bit more. I gave you a forecast last week, and I've got my wife would be appalled, but I have a way of kind of showing some slides with you, but it is not very high tech. It is certainly not high quality. So please forgive me in advance, but I'm going to share some things with you. And I've got my computer right over there, my laptop. You'll see it in just a second. When I reverse the screen on this bad boy, if I can find a way to do that now. Where did it go? Oh, gosh. Where did it go? I'm struggling with my Facebook I had an icon here. I don't know where it went, but I'm going to try to fix this as we go. Oh, found it. All right, live broadcast. What are you going to do? So let's jump right in here because we've only got 30 minutes and we're already behind schedule, and my technology is going to be a little bit rough. So y'all just bear with me, and I'm going to jump right in and say that the Federal Reserve is going to have a huge impact on this year and on everything involved in real estate and in mortgage financing. And as a result of that, they've already started. In fact, let me just tell you what they're going to do. And pardon me when I look over to the side here because I've got notes on my teleprompter. They're going to be doing a few different things in 2022. Number one, they're going to start tapering their acquisition of mortgage-backed securities. Number two, they're going to hike short-term interest rates. Number three, they're going to let a certain amount of assets run off of their balance sheet. What does all that mean? And how does it happen? And how does it impact you? Okay, number one, they have already said that for 2022, they're going to start tapering, and they already have started tapering, their acquisition of universal mortgage-backed securities. What that means in very, very basic terms is that there's a market out there for mortgage-backed securities. The instruments that I create when I do a loan for you and with you, that gets sold to Fannie Mae and Freddie Mac, and that gets Fannie Mae and Freddie Mac turn those into assets and securities, basically, and they sell them on the open market. And when they sell them on the open market, anyone can buy them, really, but one of the largest buyers of these assets is the Federal Reserve. And they've been buying to the tune of roughly $40 billion a month, probably more than $40 billion a month for a long time now. For the last year and a half, maybe 2 years, they've been buying $40 billion or more every month of these universal mortgage-backed securities. Here's the thing. Bonds, and that's what a mortgage is, and that's what a universal mortgage-backed security is. It's a bond. As you buy the bond, as the price of the bond goes up, the interest that it yields goes down. It's just the way it is. Doesn't matter if it's a mortgage bond for 30 years, if it's a U.S. Treasury note for 10 years, if it's an IOU for 1 year, whatever it is, as the price of that instrument goes up, the interest that it yields comes down. And for the last, from what I recall, March of or April of 2020, when we went into the whole COVID thing, the Federal Reserve has been buying a bunch of these billions and billions, tens of billions of dollars a month. And they've done it in such a way as to try to stabilize the bond market or the mortgage market. And in doing that, and they've done a great job, but in doing that, I equate that to kind of putting training wheels on a child's bicycle. When you take those training wheels off, the kid's gonna have to figure out their own momentum. They're gonna have to figure out how to stay balanced. And the bond market, the universal mortgage-backed securities market, has to figure out how to do that with less and less buying from the Federal Reserve Board. So that's number one. They've already started doing that, and they're probably gonna finish their tapering of acquisitions, meaning the reduction of acquisitions. They're not gonna stop cold turkey, but they're gonna reduce, and probably by March of this year, 2022, get used to saying it, they're gonna kind of stop their reduction. And then wherever they are, that's kind of where their new baseline is gonna be for future acquisitions. So that's number one. After they finish doing that, they're gonna start raising the short-term interest rates. That is the rate hike. Now, those short-term interest rates do not have an impact on your mortgage interest rate. They do have an impact on the credit card balances and the interest that you're going to be paying on that. They have an impact on your home equity line of credit. They have an impact on other sorts of interest rates. And why is the Fed doing this? Well, very, very simply, we have inflation. We have a lot of inflation. In fact, we're probably somewhere at 7 or 8% inflation, maybe even higher than what the government is telling us. And the Fed's number one job for the Fed is to keep inflation down. They want to keep inflation at roughly 2%. Well, we're way beyond that right now. So what they've got to do is take money out of the money supply. Literally, they got to take money out of your pocket. They're not going to tax you. They're just going to make it really expensive for you to borrow money. The more expensive it is to borrow money, the less likely people are going to borrow money. And as a result of having less money in circulation and having less money out and about in people's pockets to use on everyday acquisitions, the less you're going to spend. And as a result of spending less, the price of things, which is now high, is going to come down because they've got to entice you, the consumer, to spend your hard-earned money and your more expensive money on stuff. And the only way that they can do that is to make it cheaper. So the thinking, the psychology here is the less money that you have in your pocket, the less capable you are of spending it, the less likely you are to just spend it on any old thing, the more conservative you're going to be in your expenditures. And as a result of us as consumers not spending as much money, the price of things that we do spend money on is going to have to come down. That's the psychology, that's the thinking. Historically, that's worked, but what the Fed is saying right now is that starting in March or maybe April, May, they're going to increase the overnight funds rate by 25 basis points, 25%, 3 times. Now, the overnight Fed funds rate, that's money that is lent from the Federal Reserve Bank to member banks. So let's say you're bank ABC and you've got, $1 billion on your balance sheet. You only really have $100 million in your vaults. The other $900 million is out in circulation. You're using that as bank ABC to make money, to loan to other people, to make investments, to do things like that. Well, if all of your depositors came to Bank ABC and said, holy moly, we want all our cash out right now. Give me my money back. They don't have it. They don't have $1 billion. They have to get that money from somewhere. That's where they go to the Fed. And the Fed would loan them money on a very short-term basis until they could shore up all of their depositors. So the depositors are made whole. The bank stays solvent and doesn't get crushed by the weight of all this cash coming out. And that's what the Fed short-term or overnight rates are. That's what the Fed loans money to other banks for. Now, here's the thing. When they raise the rates that they charge banks, well, stuff rolls downhill, guys. Banks are going to raise rates on what they charge us. That's just the way it works. And so the idea is that by increasing these short-term rates, and they said 3 rate hikes in 22, 2, maybe 3 rate hikes in 23, their expectation is to take money out of circulation and to create less inflationary pressure and to bring inflation down. That's really the Fed's #1 goal, is to bring inflation down. That is their job, actually. And so that's what they're going to do. So #1, they're going to start or continue to taper their acquisition of mortgage-backed securities. #2, they're going to raise the short-term overnight rates that they charge member banks, and by extension, they're going to raise short-term rates on all the rest of us. And #3, they're going to deal with balance sheet runoff. What does that mean? Holy moly, it sounds like a cyborg wrote that. Balance sheet runoff. Let me explain what this is. The Federal Reserve buys bonds. They buy mortgage-backed securities. They buy U.S. Treasuries. They buy, in essence, IOUs. And those IOUs have a certain length of time and a certain interest rate that they charge. How many of us have paid off a car in our lifetimes, right? You make your last payment, and then you get this wonderful letter from the servicer of the loan and from the company that you bought the car, and they include the title to your car, and you own that car free and clear. You're no longer making payments to Toyota or Ford or whoever it is that you bought your car from or financed the car through. Well, the same thing happens with treasury notes and with mortgages. I've never paid off a mortgage. I don't know too many people who have, but there is the possibility that you can make 360 payments, and by the time you're finished making payments, you own your home free and clear. That bond, the IOU that you signed 30 years earlier, is no longer valid. You can rip it up. It's done. And that happens. The Fed buys billions and billions, tens of billions of dollars worth of these mortgage-backed securities. They are backed by IOUs that have a finite period of time. When those things expire, the Fed has money, right? They've been sitting on this money, but the asset is no longer on their balance sheet. Now, the question is, what do? Do they take that money and reinvest it? Or and when they would reinvest it, they'd reinvest it in buying more mortgage bonds or more treasury bonds. Do they reinvest it, or do they put it in their pocket and sit and wait? Well, right now, that's the question. But the theory is that they're going to let some of these assets run off, meaning that they're not going to replace expired debts, expired IOUs, with new IOUs. So they're going to sit on their gunpowder and keep it dry and see what happens with the economy. And as a result of that, it's going to create more downward pressure on prices of mortgage bonds. And by creating downward pressure on prices, you're going to create upward pressure on rates. It's the dynamic. That's just the way it is. And it's already started. Let me bear with me 1 second while I fool with my computer here, and let me show you what I mean. Because the Federal Reserve had a meeting a couple days ago, and they released the notes of that meeting. And I'm going to share with you my computer screen here. Bear with me. I know it's not very high tech. I get it. But hey, it's better than what I had last time. So take a second here. That's my microwave. Okay. This is a chart that I spend a lot of my life looking at. This is the chart for the cost, the price of the universal mortgage-backed security. This is the instrument that the Federal Reserve Board buys in the open market and has been stabilizing the price of. Now, if you look, this is my hand, here we go. If you look right over here, this is what happened yesterday when the minutes, the notes from the Federal Reserve meeting that had happened earlier were released. This is when they said to everybody, like, we knew it was coming. We had an idea that it was coming, but this is what happened when they said to us, yes, we're actually going to do what we said we're going to do. And this is the price of the bond. So the prices went down significantly. Look, the green, by the way, guys, the green bars here, the green candlesticks, these are up days in price. So when the price goes up, the rates or the rate environment comes down. And when the price goes down, when you see these big red candlesticks here, that means the price of the bond is going down, and it means that the interest rate environment is going up. And if you'll see, that is a big down day. Here's another relatively big down day. That's today. So we had follow through selling, and here we are. Welcome back. The outcome of all this is that interest rates on mortgages are going up, and they've already gone up. In fact, they've gone up by about 0.25% to 0.3% over the last just few days. It's not going to continue to go up that high that fast, but the market has been kind of shaken by the lapels, and everybody's like, oh, they're serious about this. They're actually going to do this. And yeah, the Fed is actually going to do this because they have to, because their mandate is to deal with inflationary pressure. And inflation is real, it's happening, and it's not transitory, meaning that it's not going to just come and go like the wind because we want it to. We have to make it go away. And so what the Fed has done has already had an impact, and it's going to continue to have an impact. It's going to have quite a few different impacts. In the short term, the expectation is, let me check my time here, we're good. In the short term, the expectation is that rates are going to go up. Mortgage interest rates are going to go up. So if you're thinking that things are still starting with a 2, that ship has sailed a long time ago on the 30-year fixed. If you're thinking that you're in the low 3% range, 3.125, 3.25, not so much anymore on the 30-year fixed. Now we're at 3.375. And it's ticking up. We might be at 3.5. I would say that by middle of the year, we're going to be at 3.75. That is my best guess and the best guess of the prognosticators and market watchers that I pay serious subscription fees to for information and wisdom. So now that's not terrible. I mean, look, in 2019, two years ago, 2.5 years ago, whatever it was, I was doing mortgages for people at 3.875. So it's not cataclysmic or anything like that, but if you were expecting an interest rate at X and it's going to be X plus 0.25% or 0.3%, that may come as a shock to you. And if you're really, really tight on what you can qualify for and every little dollar counts and you see something like that happen, it could be significant. Now, there's always Newton, one of his laws of nature is that for every action, there is an equal and opposite reaction, right? And so this is also what happens with the Fed. When the Fed historically has done what they've done, and that's happened in the late 70s, early 80s, in the late 90s, early 2000s, and now here we are again in the early 2020s, when they've done this, some things have happened. First of all, it has in fact brought inflation down. That's great news. That is fantastic. But it's also had a huge negative impact on the stock market, on the S&P. And I'm not a market expert. If I was, I'd be doing something slightly different than what I'm doing, but making a lot more money for it. In any event, the reason we're thinking it's going to have an impact this time around is because the markets and the stocks that we've seen just going up, and up, there's been a lot of very, very cheap money floating around in our economy for years. And that's courtesy of the Fed. The Fed has stimulated the economy by keeping short-term interest rates really, really low. That's the federal overnight rates that I said that they loan to banks. And when they loan to banks at low interest rates, the banks loan to us at low interest rates, and they loan to companies at low interest rates. And so you can access money really cheap and plow it into the stock market. And guess what? You're a genius. You're a hero. Your stocks are going up. Your costs are down. Everything's great. Well, all of a sudden that money's going to be more expensive. People are going to exit the stock market. Historically, and I don't want to scare anybody or whatnot, but the last time stuff like this happened was in the early 2000s, and that was Alan Greenspan, who spoke late 1990s, early 2000s. Alan Greenspan was the head of the Federal Reserve Board, and he spoke and said basically that the markets are experiencing a term he coined irrational exuberance, meaning that people were paying way more for stocks than the stocks were worth. And the reason is because the market was going up, and who cares what they're worth as long as I make money. When Greenspan started hiking up the short-term rates like we're talking about doing now, like Jerome Powell, our current Fed chairman, is going to be doing, when that happened, the S&P sold off by 50% over a couple of years. That is a huge sell-off of the stock market. I don't think any one of us would like to see our stock portfolio, our 401k, our IRA, or whatever it is, take a 50% haircut. It's inevitable. I'm not saying it's going to be a 50% haircut, but it's inevitable that when you start taking all of the cheap money and the easy money out of this system, which the Fed has to do in order to curtail inflation, when you do that, there's going to be a reaction. And that negative reaction is that the stock market is probably going to feel a lot of pressure. And so that's something that we have to be on guard for. That's something that we have to be mindful of, because the Fed has very, very few tools at their disposal to be able to handle their job, which is to keep inflation down. And, when all you have is a hammer, the entire world looks like a nail. And that's where the Fed is right now. All they really have is this hammer. They've got the short-term interest rates, they've got the universal mortgage-backed securities and the treasuries that they've been buying, and they've got that runoff of their balance sheet. That's it. That's all they got. And they're already doing all three of those things, or two of those three things, with the third one coming. So get ready, guys. It's not the end of the world. It's not cataclysmic. It's not horrible, but there's going to be, in the first half of this year, I would say, some real volatility in the markets, both in the mortgage markets, in the stock markets. The housing market's already been crazy. So more of the same. Now, there's always a silver lining. Thank God for silver linings, right? The thing is that once they've gotten inflation under control historically, both under Alan Greenspan and before him in the early 80s, Paul Volcker, the interest rates on mortgages, the long-term interest rates, once inflation kind of calmed down, the long-term interest rates came way down. So you may buy a home right now or finance a home right now at 3.5 or 3.75 or whatever the rate is when it is, but the expectation is toward the latter half of this year and into 23, there's going to be refinancing opportunities. Because if the Fed can, in fact, get inflation under control, then the long-term interest rates, which love low inflationary pressure, those interest rates will also come down. And so there will be opportunities to refinance. So don't look at this like the end of the line or the end of the good times or anything. We still live in the best country on the planet. We still have very, very low interest rates on 30-year notes, no less, on 30-year mortgages. No other country in the world offers money for fixed rates at 30 years. Nobody does that. Only we do. So we have some great advantages. We have some great opportunities. But at the same time, we do have some short-term choppiness, and the market, as I showed you on the chart, has already started to price that in. It's just the reality of where we are. Add to that one last wrinkle. Let me check on time. Yep, we're still doing good. Add to that one last wrinkle, which is COVID. Anybody's ball game. I don't know. Historically, we've never had COVID. We've never had a shutdown of the largest economy on the face of the earth in the history of man and woman. We've never had that happen. And so we're coming out of something that is going to take a little bit of time to kind of reorient ourselves to begin with. But then who knows? Who knows what the next variant is going to do? Who knows what the next lockdown, hopefully we don't see that. But that is still a wild card that's in circulation, and we have no idea, no concept of when it's going to hit, where it's going to hit, and the impact of that hit. Hopefully, we're done with this. I'm ready to be done with COVID. I don't know how you guys feel about it, but I'm over it. I'm ready to put that in the rearview mirror and be done with it forever. But it's still out there. And governments are still dealing with it. Economies are still dealing with it. Our supply chain is still dealing with it. And so it could still pop up. It's like whack-a-mole. It could just pop up from some unseen place, unexpected place, and cause us some additional grief. So take all this with a grain of salt, because there's some things that we still can't really control. But historically speaking, we've seen this before. And I will continue to talk about these cycles next time and the time after that. But major takeaway, short-term interest rates are going to go up, which means that your credit cards, if you're carrying a balance, they're going to go up. that balance is gonna, not the balance is gonna go up, but the minimum monthly payment and the interest that you're paying on those credit card balances are gonna go up. HELOCs are gonna go up as well. So if you have a home equity line of credit that you've taken out for home improvement or for other things and you're not really sure how to pay it off, let's talk about doing a cash out refinance, pay off that HELOC, pay off those credit cards, get rid of all that short-term debt that will be impacted heavily by what the Fed does in the coming months throughout this year. Let's get rid of that debt so that you can sit at a better interest rate on a 30-year fixed rate mortgage that's not going to go up. And then later on this year, beginning of next year, assuming that the Fed's efforts are fruitful and they bring inflation down, well, along with that inflation, those long-term mortgage interest rates on the 30-year fixed will also come down. And then we can do another refinance to a lower interest rate. What I'm trying to do for you guys is what I think about doing for myself always. How do I maximize my cash flow? How do I maximize the money that I can spend to enjoy my life and the quality of my life while using good debt to do that? And I can help you with those strategies. But we see what's coming. The Fed has announced it. The market has read what the Fed has announced and has responded, and we're here now. So let's look at not yesterday's rate and last year's rate. Let's look at what's happening today in our economy. What can we do today and what can we do tomorrow to make your lives as good as possible, as celebratory as possible, as enjoyable as possible, to maximize your cash flow, to maximize your joie de vivre, as the French say, your joy of living, and to minimize the downside risk. I'm happy to have that conversation with you guys. Wow, we're at our time. So please call me, DM me. This is real. This is serious. I've lived through this now. This is my third go around. I was 8 years old when we had our first really big bout of this in 1978, and then 10 years old when Paul Volcker took over for the Fed chairman and saw the first go around. Then we had, what's his name, Greenspan in the late 90s. I'm old enough to have done this a few times. I know what's going on and I know ways that I can help you. So please give me a shout, DM me, however you want to reach me. You know where to find me. Let's figure out what we can do to stop the pain and to make it as easy as possible. We've got plans. We'll put them together. I'll continue speaking with you about this next week and the week after. But until then, please stay healthy, stay safe, stay sane, and thank you so much for spending a little bit of time with me as I went through a really fast, down and dirty spiel. Thanks again. Have a great day and a fantastic weekend. Bye-bye.